known as technical analysis, which refers to the study of the financial markets based on price movement. It uses the assumption that price or the price of a share or an asset reflects all the information about that asset, including all market sentiment as well as perceived value. Charting refers to technical analysis that is performed through a careful inspection of price data for identification of well-known patterns that emerge in price. For example, head and shoulders, channels, triangles, and wedges. Now, some people believe in these patterns and others don't. Some people believe in technical analysis. Some people want to trade from RSI and stochastics. Other people want to trade from trend lines and support and resistance lines. Others of us want to use Fibonacci levels. Many of us are just fundamental traders. But chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between the buyers and sellers of financial instruments in liquid markets. Now, no matter how you want to explain it away, what it really comes down to is the markets are all based on psychological actions and reactions. It's made up of human beings. Whether you're a human being at a hedge fund that's sitting with all the best technical analysis tools and black boxes and computers and robots and quants and everything else, still the final human being that's making a trading decision. Even if you look at how these major hedge funds play the markets, set up an asset to trade, they will use robotic trading as they're setting up a position. They might say, okay, we see a move for the euro US dollar day, so we're going to jump in 100,000 and 200,000, 300,000, or every few minutes for next year. They'll let their computers do it at the right price and the right time. But when they're ready to dump in their million, or it's the physical trader, the human being that makes that decision. It's also the human being that's analyzing all the data these robots are giving to actually make sure that they want to make that trade. So pattern formations do not form a trading system, but rather provide an indication of future trends of an asset as the price breaks key psychological barriers in the form of support and resistance lines. Now, there are numerous types of patterns, all named according to shapes that the price graphs form between the support and resistance lines. Some of the most popular ones we know: triangles, that's ascending, descending triangles. We have channels, we have wedges, we have head and shoulders. We have double tops, double bottoms, triple tops. I've even seen some called, there's arches and there's aches and there's teacups. There's all kinds of stuff out there. But there are some basic ones that we all should know. And even if you don't understand and don't want to believe in all this psychological stuff, just a simple evaluation can help you, or simple visualization can help you understand it. One of the most popular and well-known and well-respected of these patterns is called triangles. A triangle is formed between converging support and resistance lines. So you have, let me just get my marker on here. You have a support line, you have a resistance line, and when they converge together with both lines on the same trajectory, we have them as symmetrical triangles. When we have a hardcore support line and a horizontal resistance line, we call those ascending triangles. When we have a horizontal support line and an angled resistance line, we call them descending triangles. The names aren't really that important. If you can just take the real basics, what do you see when you have a formation of a triangle? Don't tell me. We don't need to talk about all the big number stuff and all this technical analysis stuff. We don't have to talk about all the psychology of the markets. What do we have when we have a triangle? We have a wide base that's coming to a narrow point. What does it tell you? It tells you that price is getting pushed into a corner, and at some given point, it's going to break out of that. As you see, the buyers and sellers are being pushed together. Now, this can be because there's buyers and sellers are leaving the market. This could be for many, many reasons. But at some point, it's got to break out of that triangle. Now, there's no guarantee that it's going to break up or down. But if we see that the price is getting pushed in that apex of the triangle, we can be sure that at some point it's going to break up or down. Okay. Now, there are many ways we can spot that breakout and support that breakout. So when it breaks that triangle, from that breaks out of the triangle, it's going to have certain momentum. We can see the amount of volume happening, and there's actually ways that we can calculate that momentum. So even if you put, so if you say to yourself, technical analysis and all this stuff is hokey pokey, okay, well, these are just common sense things. This is not some hocus pocus. This is just an assumption you would make when you see these formations happening. Well, if you see price getting wedged into a corner, what happens when a dog or a cat or a lion gets wedged into a corner? They eventually strike back. Now, there are specific variations of triangles that can occur, namely ascending and descending. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. Now, as you can see in these three pictures to the right, they get a little bit more complicated to notice than they do on these easy to look at pictures here on the left. Okay. In the reality of real trading, spotting these is a little bit more difficult than just drawing a triangle. But when you find them, they are valuable pieces of information. Now, it's important to note that an ascending triangle can be found in a downtrend. So the combination of the name of the triangle and the market trend is deceiving. So just recognize the pattern. Thus, the financial asset needs to test the resistance level twice, and the asset closing price needs to be higher than the previous close. In other words, the closing price has to follow the rising trend. Next, we come to volume. When in an ascending triangle, volume usually contracts, although there are a few number of cases that shows volume has not contracted, but the pattern has been displayed. This has been signified by the blue line on the bottom of the chart. So when you place your volume on the chart, you would expect as price is getting stuck into that apex, that center of the triangle, the point of the triangle, the volume should be relatively low. Volume should have contracted. And as it breaks out, what does it mean? The asset means that the traders have made a decision. You know, they haven't gone around the world and taken a poll, but something has now moved all the traders around the globe, and you see this jump in buying or selling. Now, we also have lots of other patterns. We have channels and rectangles. These are ones I don't pay much attention to. You can. There's all kinds of things, and I'll show you some live charts with them on it. But you know, there's all kinds of lines we can put on a chart. Now, channels are helpful in looking at price action. We have up channels and down channels. We have wedges. We have rectangles. Okay. Now, the fact is, a lot of these are helpful, and a lot of them are left up to you to do interpretation. Let's go look at some charts. Okay. So here's a simple version on charts. We can see this is not actually a price chart. I mean, there is a price chart in the back, but this is not any particular asset. But here we can see falling wages. If you learn about trends and the impulse waves of trends, where you have 5 waves up and 3 waves down, or you learn Elliott wave theory, you can see these channels or these wedges falling or developing. And when they develop with these these impulse waves, we can analyze those. So here we can see falling wedge reversal pattern. We see flag formation with continuation pattern. We can see descending triangle with reverse pattern. And I'm going to leave this up on the screen for a minute for you to look at, because here I've broken it all down for you and you can actually see the formation. Now, some of these are called flags and pennants. Sometimes you hear those words used more often. Flags are channels, but you recognize them and you see these often in trading patterns. So here we simply have the euro US dollar on a 15-minute chart, and we had a channel up. Well, what's a channel? Well, the channel is simply a support line and a resistance line drawn above and below the moving prices. Okay. And using swing highs and swing lows, or opens and closes, or in candlesticks, the height of a candle. And as you can see, when we expected price to go up in the channel, at this point, we expected it to bounce to this level and then come back down to this level. And we'll talk about shortly how this level was calculated, because there's a way to calculate it based on the distance of the channel. And look at that. When price fell, look at how important that calculation based on that channel was. Here we see a beautiful triangle forming in silver. Okay, and as we can see price moving into the center point, this apex. We see all the waves we've got on here marked, all of our impulse waves. And we're going to expect price to break out either up or down. A breakout can be up or down. Okay, but we're expecting price to break out of that channel. Now, if we look very carefully, our indicators down below are totally indecisive at this point. RSI is in the middle. We have MACD that's telling us nothing down below. Okay, and I don't have volume on here. I should have volume on here. But we have a beautiful triangle formation that's going to tell us something. And we're going to go look at the formulas for channel triangles and breakouts, because when price breaks out, it breaks out with a certain calculable momentum. Here we see 3 beautiful triangles formed on Bitcoin, and we can see it just recently broke out of the apex, and this is the current chart. So it just broke out here, and we expect it to move to 7102. Okay, where does this number come from? Well, this number can be calculated based on, and I forget what this is called, but this is the height of the overall movement of that triangle. But there's something, I don't forget what the third leg of a triangle is called, hypotenuse, I don't remember. But there is a way to measure this distance and then apply it to, and I'll give you the formulas in a second. And then we have another chart on Bitcoin. I just want to get all the markings off of here. And again, we see a wedge formation up here. We have a channel formation, and we're predicting here the movement of the impulse waves within this channel. So we can expect this impulse wave to push it here, this one to bring it down here, and to push it back here. Okay. And then at some point, we're expecting a breakdown, and you can predict where you'd expect price. Look at as the asset has moved into this channel. Okay, how low volume has fallen. We also are using other indicators, and our indicator trend lines are supporting that movement. And both of them are well within the means, but this is simple chart patterns. This chart looks a little bit complex. This is a very simple, easy one. 3 triangles, each one predicting price movement. Silver, the formation of a beautiful triangle with all of our impulse waves and everything else laid out for us. Okay. Now, let's go back and talk about what we might want to do when we see these. Okay, now one of the most popular patterns is called a head and shoulders. You hear about this all over the place. And it is it's a complex little pattern, but when it happens, it's quite reliable. And that's why it's stuck around so long. A head and shoulders pattern is exactly that. It has a head and two shoulders, a left shoulder and a right shoulder. But it takes a long time to spot it, but there's nothing, it's a full reversal pattern. And it's a reliable reversal pattern. But we don't even recognize its development until it's making the right shoulder. So in other words, price pushes up, takes a point higher, dips down, comes down, and forms a support line here, bounces off of it, comes back up, and the next price movement is higher than the previous higher high. And then it falls back down and comes to that same support level, which then is renamed a neckline. So this is the left shoulder, just like a human being. This is the head of the human being. And then the price bounces off that neckline to start forming the right shoulder. At this point, we might want to take some notice because until it comes to this formation, it's a lot of movement to make all that formation. And until it starts bouncing back down, we have no idea what it's going to do. And it still has to bounce all the way down and come down to this neckline again before it gives us that reversal. But once we see it form this right shoulder, we can then start using this. And it's a very reliable pattern. As you notice, it's taken a lot of price action to form that head and shoulders. And we have an inverse head and shoulder, which is the opposite, whether we're coming off of an uptrend or a downtrend. So the popular head and shoulders pattern is essentially a triple top pattern, except that all the peaks hitting the same resistance level. The head peaks slightly higher than the shoulders. Now, some investors have all types of specific beliefs about how much the bearish pullback should be, how much higher the head should be. The fact is, imagine it's just like a human being. Some of us have long necks and big round heads. Some of us have short heads. Some of us have straight shoulders. Some of us are a little hunched over. Some of us are leaning down. So we can use these visual images in the formation of the head and shoulder, because we're not going to find everything exactly by a rule. Because in reality, to actually spot a head and shoulders pattern is quite difficult. But when you find the formation, it's pretty reliable. Now, once you see the development of head and shoulders, there's actually calculations that will help you predict where the momentum should take, or where you should take your target point, and where the sell pointers or the market entry sell point would be. So here, as we can see, we have this head and shoulders. We have the left shoulder base down to the neckline. We have the head that's come up here, form the headline, come back down to that neckline, came up to form the right shoulder, came back down. When it broke the neckline at this point, that's giving us this sell. Okay. It was coming off of an uptrend, and we got the formation of the head and shoulders pattern, which is giving us a reversal. And when it breaks that neckline after the formation, the full formation of the right shoulder, it's giving us a sell signal. To calculate our target point, because we have to calculate target point, stop loss ratios, profit and loss ratios before we make a trade, is very simple calculation. It's the target point, or how low it should go, or where we should expect to book profit, is the neckline minus the head minus the neck. And that will give us our target level. Okay. We can use the reverse also to set our stop loss point. A head and shoulders indicates both the end of a trend and the possible change in direction of an asset. The pattern's lows are connected by support levels called the neckline. If the price falls below the neckline or support level, a sell signal arises. The inverse head and shoulders patterns are a trend reversal indicating the change in the direction of trend, and it's the exact opposite. Then we also have a little bit more complicated patterns, and we mentioned a head and shoulders is just a variation of a triple top. and we have multiple tops and bottoms. These are chart patterns to develop using support and resistance lines where price moves up, bounces off, it comes back down to a support level, bounces back up, and goes to the same resistance level and bounces off of it. It's almost forming like an M and a W. Okay. To be honest with you, I put no value whatsoever in double tops and double bottoms. Especially if you're trading Forex and CFDs, they happen so often that it doesn't really tell you anything. Because for price to bounce up, bounce down, bounce up, bounce down, now, it might, if you see it and notice it, you might want to pay a little attention to it. Okay. But double tops and double bottoms are quite common. But then we go to triple tops and triple bottoms. Now, once a price is moved up to the resistance line, fallen off of it, bounced off the support, and resistance bounced off, and basically, these are not support and resistance from pivot points or from Fibonacci's. These are simply by drawing straight lines across, and you can see that price bounces up and forms its own higher high, falls down again and forms a lower high, bounces back up and forms that same high that you had before, bounces down and moves back up and forms that same high before. That becomes your resistance level. So you have 3 times that it created its same resistance level and 3 times that it hit that same support level. When you have these triple tops and triple bottoms, they are very, very important reversals patterns. Okay. This is a stronger indicator of a trend change than a double top or double bottom. Look for a strong initial trend and a significant breakout in order to confirm the reversal. Now, a triple top is a price pattern which is formed in an uptrend and is followed by a drop in prices. The pattern comprises 3 consecutive peaks arranged at the same level and 2 bottoms. The highs and lows of price are connected by resistance and support lines. The formation is considered to be complete if the price breaks the pattern's minimum. It can be interpreted as a downward direction of a trend serving as a signal to sell. So when it forms the triple top and then breaks that support level, it's generating a sell signal for you. And if you want to calculate your target, it's simple. It's your support minus the height or the resistance level, the top. Okay. A triple bottom is the exact reverse. Remember, in our markets, there's always one for an uptrend and always one for a downtrend. They're just flipped over top. Now, it's an important measure of the quality of a pattern is the trend that it's preceding. It's always important to look at the trend, whether it's not just whether it's an uptrend or a downtrend, the momentum of the trend, how well developed that trend is. If you don't understand development of trends and waves and impulses, you should come to our class on trends, because trends and trend lines are different. And you can have very strong, well-developed trends or very weak trends. When you have a weak, erratic trend, that signal has less validity. When you see it happening in a well-defined trend as well as a well-defined pattern, it carries a lot more validity. So the well-formedness of the pattern is interpreted based on the trend also. So remember when we were looking here, okay, look at the beautiful well-formed pattern we have, okay, the well-formed triangle we have. And we can see in this triangle, each one of these trend lines, you know, the trend moving up, we have here. Basically, it came back down, and we could have probably calculated Fibonacci level, but we can see each one of these impulse waves clearly defined. That's why you see the ABC, the 1, 2, 3, 4. These are the impulse waves of a defined trend. Okay, and when you can see these, let me just open this up a little bit more so you can see them a little better. Okay, when you can see these, that triangle has a lot more validity to it, or it will be a lot more valuable to your trading because it is part of a very well-formed overall price movement instead of an erratic price movement. Now, the pattern is said to break out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it's called a continuation pattern. If breakout is the opposite direction, it's called a reversal pattern. For example, a pattern described as a bullish reversal triangle would mean that it's a bullish signal. That is, the breakout was through the resistance line upward. Because it is a reversal pattern, that means that the preceding trend was in the opposite direction as the breakout. That means the preceding trend was bearish. Simple, it came off of a downtrend and broke up. Now, once you've identified these, there are actually formulas based on the width of the triangle, the support and resistance lines, or the height of the triangle, that you can use to calculate your target point, your entry level, as well as your stop loss level. Now, these are not my own unique developments. These are not my own patterns. And unfortunately, I don't have a handout for you. If you simply go to the internet and do Forex price patterns, you will find these. You'll find the same screenshot and you'll find the mathematical calculations, which are very, very easy, of where to put your stop loss whenever you see one of these patterns. You can calculate very easy where to put, like when we see a bearish rectangle, which we call a triple top. We would put our stop loss right above the resistance level. We would enter when it broke below the support level. And where would our target be? Our target would be equal to the difference distance here. Okay, a bearish pennant, our stop loss would be at the point of the highest, the higher low that it had made previously. Our entry point would be when it broke out of the triangle, and our target would be equal to 1.5 times this distance here. So there are standard easy formulas that you can use. Okay. I'm sorry. So like I said, just go on the internet, do a search for Forex price patterns, and you'll get these standard formulas, and keep them on the side of your computer. They are quite accurate. They do give you a very good way to a whole little trading system of where to enter and exit the markets, where to put your stop loss and take profit. You don't need anything else. Okay. All you want to make sure is you look for high probability trades. You want to look for well-defined trend lines or well-defined trends, and then drop the pattern. And when you see the pattern develop, like we saw on silver, okay, you can calculate all of this. And when you're ready for that breakout, you know exactly where it is. So you can pre-enter it. You can, set up your limit order by using your entry point, your exit point, and if it breaks out in that direction, it'll, you set your buy order at one direction, you set a sell order at the other, and when it breaks out, up or down, you can take advantage of it. Okay. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. I hope you learned a little bit, but chart patterns to me, and I'm a technical trader, I've been trading for a very, very long time. I rely especially on triangles. I like head and shoulders, but head and shoulders for me are too complicated to search for. And I like triple tops and triple bottoms. Okay. All the rest help you look at a chart chart pattern, and at least try to make some sense of what price is doing, what price action is happening in the marketplace. If you can make sense of it, you can trade it. Okay. Simply using chart patterns combining with volume. I mean, let's see, we're looking here at the Bitcoin price. Let's drop on volume onto our chart right here. Now we can see that we added volume on here. We can see when we just got the breakout here, we had a huge push in volume right here, and that's what broke us out. Volume has stayed and the prices stayed above it. Now it stayed outside that triangle and continued moving up. Would I buy? I would probably buy to that 7102 level, which I developed, which we developed earlier. Okay. But again, we have very, very precise calculations to calculate these. But here is a simple whole entire trading system based on nothing but a chart pattern, without something very, very confusing, without something very difficult. Because remember, it's all really about moving the odds in your favor, setting your stop losses correctly, letting your traders run, and getting out of the market with the smallest loss, because you're always going to have losing trades. Okay, it's to lose as little as possible on the losing trades and make the maximum on the successful trades. And a simple system sometimes is the best system, so that you can set high probability odds trading and get them in the right direction without getting yourself overlost in an over complex system. So on that note, again, I'm going to say goodnight to everybody. Thank you very much for joining us, and we'll talk to you again real soon. Bye now.